The question is that the motion be agreed to. I call the Honourable David Cunliffe.
Thank you, Mr Speaker. Mr Speaker, Labour welcomes the introduction of the Insurance Prudential Supervision Bill 2009 and will be supporting the bill through to Select Committee, and we look forward to hearing a wide range of submissions from the industry and from affected parties. Mr Speaker, sadly this bill does not go far enough. While we support the broad aim of broadening and improving the prudential supervision capabilities of the Reserve Bank and welcome in principle its extension to the insurance industry, we note that the government has had little to say about other broader enlargements of the prudential supervision role. Mr Speaker, in this brief introductory set of comments, I planned to reiterate the key contents of the bill, to briefly cover some of the risks and benefits that it potentially holds, in particular noting some of the concerns of the domestic captive insurance industry, and then to talk about the broader mandate for prudential supervision that I have outlined. Mr Speaker, the key provisions of the bill include to obtain a licence when one has met the criteria for eligibility, for an insurance company to maintain solvency, to obtain and publish financial strength ratings, to meet fit and proper standards, of course, for directors and relevant officers, to have and comply with a risk management program, to appoint an actuary, to prepare an annual financial condition report and six monthly financial statements, and to maintain at least one statutory fund that relates to the life insurance business and is solely for the purposes of meeting life insurance liabilities. So the bill recognises and accommodates the supervision of overseas insurers based in New Zealand by the home regulator, subject to such regulation meeting the satisfaction of the Reserve Bank. And on that, Mr Speaker, I would note that the Labour opposition would underline the importance of the independent, full-service role of the Reserve Bank that we currently enjoy. And we note that there has been some discussion in the media, particularly from some of our Australian banking colleagues, about seeing the extension of APRA's, the Australian Prudential Regulatory Authority's, oversight to cover the New Zealand market. So the Labour opposition would vigorously oppose such a move, believing that it is in New Zealand's national sovereign interest that we maintain a full-service, independent Reserve Bank in this country. And so we welcome, at least in principle, the extension of that Reserve Bank's role to include the prudential supervision of the insurance agency in concert with such specialist advisors as should be appropriate. Sir, there is considerable detail contained in the bill around the licensing provisions, the risk management requirements, what defines a fit and proper person, the statutory fund separation for life insurance and similar long-term insurance funds, capital adequacy and solvency standards, and appropriate financial and regulatory reporting. The bill also covers insurance credit ratings and the supervision framework, including effective distress management provisions. So the bill has a number of both costs and risks as well as potential benefits, and we look forward to those being debated through a proper select committee process, such as we did have in the last tax bill to pass through this Parliament, such as we did not have in the preceding tax bill, and as we certainly did not have in relation to the emissions trading system bill. And I'm sure that the chair of the Finance and Expenditure Committee, who I expect will want to take a call, will be the first to echo that point, that all parties share an interest in a proper and effective parliamentary process. Let's hope. Let's hope indeed. Some of the costs and risks which the Finance and Expenditure Committee would want to consider in this bill's regard include the compliance costs on insurers who are applying to be licensed in the regime, that they are not excessive and that they are relevant, and that on the other hand they are sufficient to underpin a proper regulatory role that is credible and enduring. That the proposed regulatory and supervisory requirements will impose some additional costs, including the need to maintain structures to verify compliance, and that those costs are not expected to be significant relative to insurers' revenue and profits, but we want to verify that. That the compliance with capital adequacy and solvency requirements may place constraints to some degree on an insurer's operation, and we will want to examine whether those are not enough, just right, or too much, and we will look forward to submissions on that point. The regulatory reporting and public disclosure requirements will impose some additional costs, and we look forward to seeing cost-benefit analysis there. And the proposed mandatory requirement for insurers to have a financial strength rating will impose some additional costs, which of course is potentially outweighed by the transparency value to consumers of being able to obtain a better assessment of the risk base of their insurer. And that will be high in the minds of ordinary New Zealanders who've weathered their way through the recent recession, from which the country is now emerging, but which the government would rather New Zealanders thought we were still in. So the mandatory ratings requirement and its associated disclosure requirements could put some commercial pressure on some insurers and lead to others merging with or leaving the sector. We'll want to know how many, what degree of concentration we might expect in the market, whether that raises any competition concerns. We'd be interested in the view of the Commerce Commission potentially around those matters, or the Securities Commission as well, in regard to transparency and prudence. So the bank will have the power to require information from insurers. We would support that. We'll be interested to know what information. We'll want to know that the bank's powers are sufficient for it to do the job, that its powers are graduated, that it doesn't have a hole in the middle problem between the basic routine information gathering powers and the ability to escalate short of system stability requirements should there be a perceived problem that needs to be addressed. We'll want to look at the licensing requirements, the fiscal cost to the Reserve Bank, and we note that the Reserve Bank won't be charging a licensing fee for the first 3 years, so we want to look at the fiscal risk to the Crown. Sir, I note that there has been concern expressed by the captive insurance industry. They note that there will be a regulated domestic captive industry under this bill, but an unregulated foreign captive industry. And so I believe the Select Committee will want to take close note of any competitive dynamics that sets up, because I believe that all parties will share a common interest in ensuring that the New Zealand domestic industry is not disadvantaged relative to their foreign counterparts by these prudential rules, which potentially are in the interests of all. And we want to make sure that there is not a disguised incentive for the outsourcing of captive insurance programs. So that brings me now to the wasted opportunity, really, in this bill, which is the opportunity which the Finance and Expenditure Committee broadly drew attention to in respect of the Reserve Bank's announcements that it was moving into counter-cyclical prudential policy pursuant to Basel II and the G20 processes. And so it rather begs the question why the government has not advanced some intention to fine-tune the Reserve Bank Act when we have the Reserve Bank itself saying that it wants to innovate in the area of prudential supervision, when we have the government bringing forward this legislation to broaden the prudential supervision of an allied industry, the insurance industry, and yet we have the paradox that the Minister of Finance himself says that there is nothing that can or should be done to enhance counter-cyclical prudential supervision and its relationship to monetary policy. And, Sir, here I'm very pleased to note that the Leader of the Opposition, the Honourable Phil Goff, has, with the full support of his caucus, been the first to say that more work is needed in this area, that Labour withdraws from the orthodox consensus about a period which is now past, prior to the global financial crisis, prior to the Basel II process, prior to the G20 process, in the days when inflation stalked the earth as the only problem of note. And now in this post-recession environment, sir, it is growth and jobs and the potential for recovery that is as important as inflation control and price stability, but the government appears not to have got it, sir. They have not got it by the statements of the Minister of Finance, and they have not got it in this bill, because here they are, probably quite rightly, broadening prudential supervision into insurance, but missing the opportunity to have Parliament scrutinise the broadening of the prudential role of the Reserve Bank in the banking sector, which is, of course, the key issue. And
I regret to advise the member that his time has expired. I call